Hi, my name is James. I'm part of the business development team at Willow, and I'm here to talk to you about cap rates. Cap rate is the relationship between the amount of income the property generates versus the cost or value of the property. So if you take the rental income and fees that your property generates and divide that by the amount you paid for the property or the potential value of the property, you receive the cap rate percentage of the property. So if you have a $1 million property that generates $50,000 in annual income through rents and fees minus operational expenses, then you have a 5% cap rate. Simple, right? This is why people love using cap rates to advertise a given property. It's an easy to understand metric in what's an overcomplicated and jargony field. You cannot let cap rates, however, dictate your investments, because cap rates are just a snapshot of the potential value of a property. And if you're making investments based off snapshots, the real world is going to smack you in the face very soon, and you're going to lose a lot of money. Cap rates are a good signifier of risk as well as potential value of a property just based off of that positive cash flow. But that is not how we dictate value in real estate. The way to make money in real estate is through property appreciation. And this is something that large-scale commercial real estate investors understand. It's also why it's such a difficult field to break into. If a property is high risk, it will likely have a high cap rate. This is easily demonstrated when you look at urban versus rural real estate. Urban real estate is so much more attractive to commercial real estate investors, but it's more expensive while also having a lower cap rate. Why is it the case if you have less positive cash flow and a higher price of entry that commercial real estate investors go for urban all the time? It's because of all the other factors that cap rate doesn't account for. When you're looking at an urban area, urban areas have much higher population to pull from, higher foot traffic, better amenities, luxuries, schools, hospitals, you name it. The only thing they're missing is maybe parks. Whereas if you look at rural real estate, it can be much harder to find a proper, stable tenant. Not only do you not have all the benefits of living in an urban area, you also do not have access to the large pool of tenants that an urban area can select from. This is not to say not to invest in rural, just that if you're investing in commercial real estate, urban is likely going to be the safer option. A benefit of the cap rate formula is you can also use it to reverse engineer for the value of a property you're considering. All you have to have is the net operating income and the cap rate percentage, and you divide the net operating income by that cap rate percentage, and it should give you the approximate value of a given property. If a property's cap rate is much higher than those in its general market, so if you're looking at an office property in downtown Toronto and it has a much higher cap rate than other similar properties in a similar area, that's a red flag, and it could signify things like a bad tenant, overpriced rent, or the need for capital expenditures. Capital expenditures are things like roofing, new windows, HVAC, electric, large expenses that should only happen once every 10 to 20 years. So, cap rates, while a great snapshot of potential value and risk return on a property, are not the be-all and end-all of any investment deal that you are looking at and should never be. I understand that this can be very intimidating and seems like a lot of information to take in. So if you have any questions or concerns, please feel free to click the link below or set up a time with one of our experts who would be glad to go over this with you.